Ireland appears to be inching towards a bailout today. The ECB is trying to persuade the Irish to accept an infusion of capital for its banks. There's concern that if Ireland doesn't agree to a rescue, the crisis could spread and destabilize the euro and the entire eurozone. The head of sovereign risk at IHS Global Insight says Ireland needs to accept that bailout to calm down the markets. Jan Randolph joins us now from London. Jan, are you optimistic we will see something today, tomorrow perhaps?
I think we're getting very close to a decision. I think what will turn the hand of the Irish, they don't really want this bailout as such, but what will turn the hand will be contagion, other Eurozone borrowing costs going up. It's not just Portugal. If German borrowing costs go up, and they have a few basis points, that's an awful lot of euros. And the second reason is ECB. ECB has pointed out the Irish banks are on a lifeline of liquidity support from these emergency facilities post-Lehman Brothers, and it wants to withdraw them. So Ireland's hand might be turned.
Ireland's hand might be turned, its arm twisted behind its back. How do you feel about the way that the discussion of terms of this bailout have changed such that what we might now see is an infusion of bank capital as opposed to something broader in scope?
Yeah, I think if you look at Ireland and ask yourself, where is the risk? The risk is in the banking system. I mean, that's been quite a common problem. But for Ireland particularly so. And the banks aren't really able to stand on their own balance sheets yet, despite repeated capitalizations. And so that is where the monies ought to be directed. And it's likely that Ireland will tap this European Financial Stability Fund to recapitalize their banks. They need excess capital over and above regulatory because there's still suspicion about losses.
Yeah, Jan, just how great is the threat of contagion that if Ireland doesn't do something, or even if Ireland does something, we're going to see it spread to the likes of Spain and Portugal?
Well, it's interesting. On a European level, big decisions like this are made not because of altruistic European solidarity, although that does exist. It's contagion. German borrowing costs are going up a little. We're seeing contagion onto Portugal. And they need to create a ring fence, a firewall, to contain the problem.
But Jan, I don't want to interrupt you, but will the Irish bailout create that firewall? Because there are some, as you know, who say, okay, so they bail out Ireland, they're just going to turn their attention to Portugal next. And the Portuguese seem to be very, very afraid of that. Well, the strategy so far has been where there is debt stress in a particular Eurozone member, you create a ring fence, a firewall, and you resolve the problems from within. For Greece, it was essentially a fiscal problem, public debt. For Ireland, it is a banking problem, and they have to recapitalize their banks sufficiently to calm the interbank markets. That is the approach, and it's the appropriate approach. And the same thing may have to go, the same strategy may also have to apply for Portugal and Spain. It depends on how investors react to the actions of the ECB, the Eurogroup, and Ireland itself. Jan, very quickly before we go, can you put a dollar figure on what's required for Ireland? Or a euro figure?
It's what would be sufficient to recapitalize the banks and make them clean, and it'd probably be about 60, 70 billion euros.
All right, Jan, good of you to join us this morning. Jan Randolph of IHS Global Insight. He says that even if Ireland gets bailed out, they may need to ring fence Portugal and perhaps Spain as well.